What do you make of some of this action we're seeing in the pre-market right now? Futures were solidly in the red earlier. They've kind of ticked towards the green at least a bit. The S&P basically flat. What do you make of all this?
Well, I think the recovery we saw last week was very justified considering what we saw in September and October. I think markets were really oversold, and the reaction was probably in large part due to the realization that the rates really are going to be higher for longer. And I think that the higher for longer narrative is going to be the most important thing that we look at. Interest rates, where are they? Yields, where are they? And how long does the Fed need to hold them higher as inflation comes down without seeing the economy and seeing growth roll over? So very, very important to listen to what the Fed speakers are talking about today. I know I'll be paying attention to that.
Yeah, so it sounds like investors, including yourself, you're now facing basically a new reality when it comes to the Fed. With that in mind, what's your WEX word of the day?
Well, the WEX word of the day is stubborn, Frank, because I think until October, Wall Street has just been stubborn to the fact of what the Fed has been telling us. And I don't want to age myself, and I know you're too young to remember 1996, but Greenspan famously came out and called the market performance in 96 as experiencing irrational exuberance. And nobody listened to him. We didn't pay any attention at all. Maybe 3 months later, it started to settle in. Probably 3 years later, it really did. And by no means am I comparing the markets, Frank, at all, just the way we're stubborn, the way we don't always listen, because when Chairman Powell was at Jackson Hole, he was very clear about higher for longer. And none of us listened. We paid no attention. And then all of a sudden in October, the market seemed to wake up to the idea that we might not be seeing rate cuts around the corner. And I'm already hearing a lot of people say, well, in the beginning of 2024, we can expect the Fed to start cutting rates. And I just think that's too premature. I think we're being stubborn in our ways as far as when this rate cut eventually comes. And if we really listen, we shouldn't be ultimately surprised if it doesn't happen until early 2025.
Wait, 1 second here, Kevin. So you're saying you don't see it coming until early 2025? We were showing some charts earlier today from the CME FedWatch tool. A lot of traders see a pretty strong possibility of it coming in May of next year, not 2025, but May of next year. So you're now saying you think that's just not going to happen. That seems like an unreasonable expectation.
I think we want to prepare for the worst and hope for the best. If we see rates in the first half of the next year being cut by the Fed, it's probably because we're in a recession and they're forced to do it. My base case is not 2025. I think that might be a little pessimistic, but I don't want to be overly optimistic. I think reality is, a year from now, as long as inflation continues to come down. They don't want to make a Volcker-esque mistake of starting to cut rates too quickly because we all want them to. We've been 2 years into this where they've taken interest rates from nothing and they've thrown 525 plus basis points of yield into the market. That lag effect takes time, but we're closer to the end. There is light at the end of the tunnel.
Got it.
So I'm much more optimistic than I was last Thanksgiving.
So for the people listening, we're looking at the CME FedWatch tool. So 40% chance of a cut in May, 42% chance of a cut in June. So I also want to bounce something else off you, Kev. Today's big consumer stat is something we're doing here on CNBC. So the big stat today, it's $154 billion. That's the year-over-year increase in household credit card balances. That's according to the New York Fed. That's the biggest increase since they began tracking nearly 25 years ago. With the consumer being a major part of the market rally we've seen so far this year, how concerning is that stat?
Well, that is concerning because the consumer is what holds up the entire economy. It's not just the market in the short term. And if you look at credit card debt at 1.08 trillion, so it's over $1 trillion, that's not consumer debt. That's just credit card debt. The problem is that the average rate on credit cards right now, Frank, is over 20%. So it's a snowballing disaster.
Record high rates right now. Definitely record. Before we let you go, Kev, we only got a few seconds here. Want to get to your two picks in the industrials. Give us the elevator pitch on why these are two great stocks to buy today.
Very, very quick. These are investments, not trades. Industrials are going to be hit hard if we go into a recession, so it's a little bit of an initiation of a position. We own Caterpillar and Deere both for the first time ever. I think investors only need to pick one. If you believe in the infrastructure bill, these companies print money. Generally speaking, they're going to be incredibly well received by shareholders through dividends, dividend increases, very low multiples, 13 on Caterpillar, 11 on John Deere. Initiate a position here and add to it on weakness.